Hello and welcome to CIA News Analysis. Tomorrow's crypto news today. In our first article, we're going to be looking at the traditional markets. We see that Federal Reserve Chairman Jerome Powell warns of slower growth, says the Fed is prepared to adjust balance sheet unwind if needed. In the article, we can read here that the U.S. economy remains strong, but dangers are brewing, Federal Reserve Chairman Jerome Powell told a Senate committee Tuesday. In his seminal annual testimony on the state of monetary policy, the central bank chief noted that the Fed is watching the state of affairs closely and is prepared to adapt policy if warranted. AKA, just as we stated in the Cryptonomics report, the Federal Reserve has complete control to adapt policy, basically to control interest rates, to control money printing and money supplies in order to manipulate the economy. While we view current economic conditions as healthy and the economic outlook as favorable, over the past few months we have seen some cross currents and conflicting signals, Powell said in his prepared remarks to the Senate Committee on Banking, Housing, and Urban Affairs. Financial markets become more volatile toward year end, and financial conditions are now less supportive of growth than they were earlier last year. China and Europe are particular areas of concern, and the Fed is watching how Brexit negotiations and trade talks play out. We will carefully monitor these issues as they evolve, Powell said. The Fed has been caught in a market crossfire in the past several months, triggered by worries that it was on a set policy path and would continue tightening even if conditions weakened. Meaning that if they continue to raise interest rates and they continue to short their books, that they could cause an economic crash or a market crash. And people were getting worried about that, which is why we saw so much volatility in the markets, and it's still there. More recently, though, officials have been conveying a message of patience with the future policy path, including both the approach to interest rates and to reducing the bonds the Fed holds on its balance sheet. So the American people have to hope that the Federal Reserve will be patient with its policies so that they don't crash the entire American economy. This is an issue, again, we highlight it in the Cryptonomics report for you to get a better understanding of their policies and their manipulative power. But we also write about this in the Trump Bump report, which was a report we published October 1st of last year. I highly recommend that if you're new with us or you haven't read this report, that you take the time to go back and read this report so that you can understand the CIA News Analysis perspective and worldview on the traditional market, as it obviously plays an important role in the emergence of the new financial system, the digital control system. In this Trump Bump report, we talk about a bunch of different things. One thing including Trump policies are so fruitful to the economy and big business, the elites are lining up to take advantage of them. Even with interest rates slightly increasing, the elites will continue to utilize cheap money policies, buybacks, and quantitative easing to boost markets and their fortunes. The integration of future fintech systems like blockchain, artificial intelligence, and Internet of Things will lead to an even further explosion of worldwide business deals and expanded market cap valuations. But not only that, we also mentioned that if Trump policy remains the same as it has been since 2016, which all things point towards the fact that the policies will not only stay but be strengthened, then we will continue to see the same results we see today, including the growth of traditional markets and the growth of debts. So do we see that here today? Do we see that Trump policy that led to that market growth from 2016 to 2018, are those policies being strengthened, or is the Federal Reserve coming out and working against Trump? Well, at first they were working against Trump with their scheduled interest rate hikes as well as quantitative tightening. But now those cross currents or mixed signals that they're getting are showing that if they continue those policies, they could very well cause an economic recession or even crash. Worst case scenario, they could cause hyperinflation of the dollar. So I think what they see here is that they're not quite ready to pull that trigger. So that is why that they are changing their tone and coming out and saying that we are not going to continue to raise interest rates. We are willing to be patient when it comes to quantitative tightening. If we need to keep our books at this size, I think over $4 trillion of bonds, then that's fine. They reduced it from 4.7 to 4 trillion over the last year. But if they continue to reduce it, it's going to add more stress on the system. Now they're saying we're willing to be patient. We don't want to poke this bubble too hard and pop it. We want to deflate it, but we don't want to pop it. So again, we addressed that in the Trump Bump report and the Cryptonomics report. Both reports filled with information, filled with knowledge that will empower you to protect your family and get ready financially for where the world is heading. All right, well, that's it for the traditional markets. Now moving into the crypto news. In our first article, we see that Coinbase exchange users can buy and sell XRP or Ripple starting today. Crypto exchange Coinbase is launching support for XRP, the third largest cryptocurrency by market capitalization. While no firm timeline for launching technical support on Coinbase's retail platforms, such as Coinbase.com or your Coinbase app on your phone, as well as its Android and iOS apps, was given, the exchange typically launches cryptocurrencies for its non-professional users within a few weeks of launching support on Coinbase Pro. Now, this is important because Ripple is a different type of cryptocurrency. It is not a decentralized blockchain. It is a distributed ledger, but it is also centralized. There is no mining process within Ripple, meaning that different people throughout the world cannot use their computing power to maintain and process the ledger and the network. It is a centralized network. It is a pre-mined network, meaning that Ripple Labs has most of the Ripple coins in their possession through a pre-mine. They have complete control of the network. So this is very interesting to see Coinbase taking up Ripple, even though it is the third largest cryptocurrency by market cap. It's just because there's so many coins that exist and the price that it's trading at. It really isn't a cryptocurrency. What it is the central banking coin hedge. I mean, Ripple is really designed to replace SWIFT, and we see that here in this quote. In this way, XRP can function as a bridge currency in transactions involving different currencies such as US dollars, Japanese yen, euros, francs, and others in use on the XRP network. So, a coin like Bitcoin is here to be currency and replace fiat currency, but a coin like Ripple is here to function as a bridge currency. And what we're going to do is we're going to see Ripple start to emerge as a replacement for the SWIFT network. You might remember this article from a few episodes back. SWIFT CEO steps down after era of tech disrupting global banking. And he has a great picture here that describes, he's like, what do you want me to do? The technology's better. There's nothing I can do. And we can just see, as a little bit of a review here, SWIFT, a messaging system that directs the flow of trillions of dollars between 10,000 institutions, was long a byword for clunky tech. Payments often took days to reach their destinations and were virtually impossible to track. This man spearheaded efforts to modernize SWIFT and stiffen its defenses against crime, but also presided over a series of episodes that highlighted the 41-year-old system's vulnerabilities. So he's going to be stepping down in June, like we mentioned in previous episodes. And what we're seeing is the emergence of Ripple, which is not necessarily a cryptocurrency in that it is decentralized and empowers the user. But what we see is a functioning bridge that is really designed to replace SWIFT, which is why here at CIA we refer to it as the central banking coin hedge. Because you can imagine if that 10,000 institutions with the flow of trillions of dollars, with that kind of demand being put on the supply of Ripple, you would have a significant price increase in each token so that you could function as a bridge between these 10,000 institutions and the trillions of dollars of cash flow on a daily basis. We can see that it is preparing to be a replacement option for that SWIFT network, which moves the timeline forward on how much longer SWIFT and this current financial system and money flow is going to be able to be sustainable and make sense when it takes time and money and energy to run that system, whereas with a system like Ripple, a centralized cryptocurrency, it's going to cost pennies and the transactions can be done within seconds. And that shows you the size of these networks. It also shows you the amount of money that these banks make as facilitators of these transactions. And speaking about being a facilitator of transactions, in our next article, we see that cryptocurrency miners are making millions for doing absolutely nothing. Well, how about this? Banks are making millions for doing absolutely nothing. Matter of fact, Wells Fargo got charged a $500 billion fine from duping their customers and having false charges for opening up false credit cards and other things like that. Yet it's the miners who are involved in a decentralized network. It's the miners who are just maintaining the network and processing transactions that are doing nothing, right? Making millions for doing nothing. No, actually, it's the banks who are loaning you not real money, but debt promises, Federal Reserve notes, promises of debt. They're loaning you that money at interest, and they're making money off of you for doing nothing, for being the policymakers and the printers of that money. That's who's really at fault here, not cryptocurrency miners. But just to touch on what they say here, that the major proof-of-work blockchains, Bitcoin, Ether, Litecoin, and Dash, have earned in excess of $18 billion. Bitcoin Cash miners have earned just under $1 billion since the fork. Zcash miners have actually earned more than Bitcoin Cash miners, and Zcash is one of the most underutilized networks studied. And I think what's even better than this article are some of the comments. The best comment right here from Charles Fettinger: what a set of farces and misleading clickbait ideas. Yeah, not bringing justice to what crypto mining really is, and not highlighting the problems that the banks have when they are handling money versus the problems that miners have when we are trying to maintain the networks. He says, what a set of farces and misleading clickbait ideas. First, crypto mining is far more environmentally friendly than fiat. That's right. The SWIFT network with 41-year-old technology that has vulnerabilities and it takes days to transfer this type of money, that uses more energy and has more costs associated with it than blockchain. And he says, considered proof of work is math, which ensures you can trust in your money because you can trust the math. You can double, triple check it, but can you trust the bankers? Fiat uses the military and police to force trust of your money. It is a proof of violence. Consider the environmental impact of war. Next, mining for minerals to print, coin, produce, and distribute fiat. Then, bankers are using more electricity than crypto mining in massive data centers and branches. It's true. We already live in a digital era. Most money is digital. It's not real, tangible money that's printed out on the paper. Not that that's real money anyway. It's just a debt promise. But they're using even more energy and electricity in these huge data centers that we see popping up all over the world. He says, next, miners are running nonstop, competing to complete a transaction. They are not doing nothing any more than an employee waiting for customers. What they are doing is ensuring availability and convenience. That's right. Just like an employee waits at the checkout line, if nobody's coming to check out to buy anything in the store, is that employee at fault? Are they earning money for doing nothing? No, they're maintaining that area and they're getting ready for a checkout. Well, miners are maintaining the network, making sure that coins are being spent the right way, and they're doing exactly what he says. They're ensuring availability and convenience so that when you're ready to send your coin or when you're ready to send a transaction into a block, that it's going to be recorded and that it's going to be trusted and that it's going to be uploaded to the network and we're going to see that transaction take place. So we just see here a misguided article trying to demonize cryptocurrency miners, trying to make us seem like, oh, we're doing nothing and we're getting paid for it, when in reality, we're offering freedom of finance from the corrupt debt-based system that exists today. And the worry is, like we mentioned in the Cryptonomics report, that in the short term, this is freedom of finance. This is an empowering system. Instead of the banks making money, everybody who maintains the network can make money, and anybody with a computer can help maintain that network. So it really does empower the people. You don't have to trust the bank. You don't have to trust the government to enforce the acceptance of that currency. It's all based on math. It's all based on a trustless system that anybody can double check. And we see that empowerment being used against us. And in the future, when it's combined with the law, when these financial systems are combined with the law, and it's the government who then picks up the reins to enforcing the transactions and making sure that everything is trustless, then it will become a system of control. then it will become a system where you lose your privacy and you lose your rights. And that's what we need to be aware of in the long run. But there's still a window of time here in the short to medium term before it's married to the law that this is an opportunity to avoid the downfall for when the Fed does raise those interest rates, for when they do say they're not going to stop quantitative tightening, and the markets do go into a recession or a crash, or worst case scenario, the dollar hyperinflates. What are you going to do to protect your wealth? How are you going to diversify your assets? Are you going to trust the bank to handle your money? That money is going to be there tomorrow? Are you going to trust the government, who's already $22 trillion in debt, plus another $80 trillion in unfunded liabilities like Social Security and other social handout entitlement programs? Is that money going to be there when they don't even have it? Many times we've heard the Federal Reserve say that the United States can just print money at any quantity to pay off a debt. We can guarantee cash flow, but what we can't guarantee is purchasing power.
Do you still believe that we should maintain the fundamental principles of Social Security as you did in 83?
Until we can construct a system which creates the savings that are required to build the real assets so that the retirees have real goods and services, we don't have a system that's working. We have one that basically moves cash around, and we can guarantee cash benefits. It's far out and at whatever size you like, but we cannot guarantee their purchasing power.
So that's the Fed's standpoint on money. They don't care about stealing your purchasing power or even maintaining your purchasing power. They just want to maintain the illusion of wealth. You're stuck in what we call the debt slave cycle, working the rest of your life, giving away your most valuable asset, time and energy, to pay off debts that they've given you at large interest rates in order to exploit their role as the money gatekeepers. Well, in our final article, we're talking about Samsung teases early blockchain partners for Galaxy S10 phone. And this is huge news because, as we talked about in previous episodes, this is going to help mainstream crypto. Everybody is using their phone. Everybody is on their phone. I mean, people are in their cars. Next time you go drive, just take a look over at the other people in their cars at a red light. They're looking at their phones. Their heads are down looking at their phones. Everybody is attached to their cell phone. This cell phone connects more people to the internet than computers do. Cell phones are the future of getting things connected to the internet, of the Internet of Things. And when we see companies like HTC and Samsung getting ready to roll out cryptocurrency wallets, we can be sure that it's going to get ready to go mainstream, because if that option is available on your phone, then it has a much greater chance of being picked up and used by mainstreamers for ease of use and ease of convenience and security reasons. So this is a big news announcement that Samsung is going to be able to partner with crypto companies in order to bring crypto wallets to their S10 phone. We see in the article that since last year, the blockchain team of Samsung Electronics Wireless Division has been searching for dApps that have been commercialized. As a result, Cosmo Chain has been selected as a partner of Galaxy S10. We did dozens of meetings to verify the model and technology. So we see Samsung and HTC and these other companies, they're getting involved in the payments game. Financial payments is a huge, huge market, and the banks and central banks have a monopoly on it. But what we're seeing is a transition, a transfer of that power and that responsibility. And it's getting away from the central banks. And what they're going to do is they'll use the law to wheel it back in. They'll throw out the law, we'll bite on it because it'll result in massive returns and massive profits for early adopters and users. They'll wheel us in and they'll gain back control of the systems through the law. But in the short term, we're going to see an explosion of financial tools and companies that are going to get involved in financial payments, digital payments, and Samsung is one of the largest phone producers in the world, and they have already made that decision, and it will be coming out in the new S10. I got the S8 right here. The S9 is already out. The S10 is the next version, so this is not something that is far out in the future. We're talking within the next 1 to 2 years, we're going to see this phone hit the market with a cryptocurrency wallet. And interestingly enough, it will be right within the cycle of Bitcoin that we talk about in the Cryptonomics report, where things are really going to start getting hyped up. The next cycle is really going to be starting, and this is going to be one of the big bullish trends that we see in this cycle that helps move the market forward, because mainstream adoption is much easier to do with cell phones and making it available to people through their phone rather than a desktop computer. Well, that's it for CIA News Analysis. Thanks for joining us. We'll see you next time.